Hello and welcome to this episode of Macro Sutra. I'm TCA Sharad Raghavan, Deputy Editor at ThePrint, and now the talk of the town, well, the country, is the unified pension scheme that the government recently announced. A lot of people are in favor of the scheme, saying that, wow, it's a good thing, government is contributing more money and people are going to get their assured pension. Other people are saying that it's not a good idea because it's increasing the burden on the government and by extension on taxpayers. But to look at the financial implications of this, how it will actually burden the government and whether we know the implications, to discuss all of that, we have with us Radhika Pandey, Associate Professor at NIPFP. Thank you so much, Radhika, for joining us.
Thank you, Sharad.
So now, Radhika, before we get to UPS, let's first talk about the difference between the old pension scheme and then the new pension scheme and how they differed.
Yeah, so primarily pension schemes are of two kinds by design. One is a defined benefit scheme and the other is defined contribution scheme. So the old pension scheme is defined benefit scheme where it is the responsibility of the government to fund the pension outlay from its revenue. So it's not based on any contribution by the employee and the employer. So it's a defined benefit, and the benefit is defined either in terms of the last drawn salary or the average of the last 12 months salary, but so it is known what is the defined benefit. That is the old pension scheme, and the new pension scheme is where it is based on defined contribution so that it doesn't entail additional fiscal burden on the government. So it is where the employee contributes a certain proportion of its of his or her salary, and there is a matching contribution by the employer, and this this amount is invested in a pension fund, and based on the returns the pension amount is determined. So in the design of the new pension system, 60% of the corpus at the time of superannuation, 60% of the corpus is to be given to the retiree and 40% is to be invested in an annuity, and based on the return of the annuity the retiree gets monthly payout. So that's
the NPS.
That is the NPS. So the NPS is contribution. So during the work life, both the employee and the employer are contributing. For example, currently the employee's contribution is 10% and the employer's the government's contribution is 14%. And this is added to a corpus which is managed by PFRDA, the Pension Fund Regulatory Development Authority. And then there are pension funds depending upon the investment appetite. This fund is invested in a combination of government securities, equity, and so on. And it's a very transparent mechanism because at the end of every month the employee gets to know the NPS of the value of the investment and so on. So it doesn't entail fiscal burden. The fiscal burden is only to the extent of the contribution that the government is making towards the monthly payment.
Okay, so then how is this unified pension scheme different from both OPS and NPS?
So UPS tries to marry some of the features of old pension scheme and the new pension scheme, in the sense that UPS is providing an assured pension to the retiree, which is not the case in NPS. In NPS, it will depend on, the 60% of the corpus you will get at the time of retirement, and 40% is invested in an annuity. Now, that amount may be more or maybe less than the 50% of the average of the last drawn salary, which the UPS is committing to, or the UPS is assuring. So the main pillar of the unified pension system is that it is providing an assured pension to the retirees to the extent of 50% of the average of the last 12 months drawn salary.
So that's the part from the OPS that it has borrowed.
That is the part from the OPS, and the part from the NPS is that the contribution, the character of contribution still continues, that the employee still continues to contribute 10%. So it's not completely unfunded. The employee continues to contribute 10%, and to ensure that 50% guaranteed payment is provided to the employee, the employer or the government has increased its contribution from 14.5% to 18%. So that's the
14% to 18.5%.
Sorry, 14 to 18.5%.
Right.
So that's the change that has happened. So the part from the OPS is guaranteed amount, and from the NPS is that the character of contribution still continues. In addition, the pension that is given, the payout is indexed to inflation. So that's another feature of the unified pension system.
This was not the case for NPS.
That's not the case for NPS.
Right.
So that is another feature of the unified pension system, that the nominal value of the payout, the pension payout, will increase with increase in inflation. So it is indexed to inflation. That's the other thing. And the third important part is that the employee also is getting a lump sum amount, which is a gratuity, and a lump sum amount which is 1/10 of the monthly emoluments at the time of retirement for every 6 months of completed service.
Right.
So those are some of the features of the unified pension system. And what's important is to look at the backdrop of this. The context is that a number of states have reverted from the national or the new pension system.
I was going to ask, so
Yeah.
which are the ones that have gone to OPS?
So 5 states have gone. Mostly the non-BJP states have gone, have reverted back to OPS. Primarily, I think Rajasthan, Punjab, Himachal, Jharkhand. They are some of these states that have reverted to the old pension system. And there was a growing clamor for assured pensions by the central government employees. And
Right.
therefore, last year the central government set up a committee to look into alternatives. What could be done so that there is lesser fiscal burden, and at the same time the central government employees or government employees could be pacified with assured pension. And so this is a kind of compromise formula in the form of unified pension system that has emerged.
Right, but now when they brought in NPS,
Right.
there was a certain nudge by the
Right.
government that they wanted the employees, their thinking to change in some
Right.
way, that from just being entirely dependent on the government,
Right.
that they would also have some skin in the game, that they would put some money towards their own retirement.
Yes.
So does UPS kind of erode that or strengthen it?
So let's look back at the NPS was the origin or the brainchild of the project called OSS. So that was the project or the committee that was set up in early 2000 to look into what kind of old age income security design could be provided, which is fiscally also prudent, and it is more inclusive. The two concerns that were emerging during the late 90s were, firstly, that pension payouts were becoming fiscally unsustainable, mainly because of the rising life expectancy.
Right.
And the notion that the government has to pay because of that fiscal burden on both the central governments and state governments was rising. That was one. And the other important consideration that came into play at that time was that this pension benefit is only given to a meager proportion of the entire working population. So almost only 11% of the working age population is getting this unsustainable fiscal burden in the form of pension payout. So to address these distortions, the NPS design was introduced. It was earlier introduced only for the civil servants, and later, when the system was put in place, everything was put in place, it was open for everybody. So in 2009, NPS was open for everybody. So in that sense, it is a more inclusive in nature. So that is not the case with UPS, because this system, this advantage of guaranteed pension is only applicable to the central government employees at this point in time, and those states who will opt for this, they will be applicable for them. So the consideration that governed the NPS, namely two considerations, one fiscal and the other that it should be inclusive, both of them are slightly diluted here because it's not inclusive, first of all, and secondly, there would be fiscal burden, though not to the extent of the kind of fiscal burden that we will notice in the case of old pension system, because recently, last year, Reserve Bank of India did a study on what is the cost of switch from the NPS to the OPS, and they found that the fiscal cost will increase by 4.5 times more than what is the fiscal burden under the NPS.
Under NPS,
so so OPS is not fiscally sustainable. UPS is kind of fiscally sustainable if we compare with OPS. But yes, there will be fiscal burden because it may well be that to assure the 50% benefit, 50% pension, 50% of the basic pay as pension, the government may have to increase its contribution further. So there will be various actuarial assumptions that will be made. In this case, government will also have to bear the inflation risk. It also depends on where this corpus is being invested. Because if this corpus is being invested in safer assets like government bonds, the upside will be limited, and therefore the contribution by the government would have to increase. So as of now, we know that there is a statement by the now Cabinet Secretary Designate saying that the fiscal cost is 6,023 crore plus 800 crore for areas, but it may well be more in the coming years. So definitely, there will be an additional budgetary allocation to meet the assured benefit component, the assured pension component.
And this 6,000 odd crore that the Cabinet Secretary Designate talked about is only at the central level and only for 1 year.
Yeah, only for 1 year.
Yes. Right.
Yeah.
And if the states also start adopting UPS, then their burden will also increase.
Right.
And that then also becomes a burden on the center because of the whole devolution formula.
Absolutely.
The center has to share its revenue with the states.
Absolutely. And currently, if we look at the pension burden for states as a whole, pension outlay is around 5 lakh crore, and for central government it is around 2.5 lakh crore. So states is more as compared to central government, and there is a lot of heterogeneity as compared with regards to the pension outlay, with some states like Punjab, Assam, Rajasthan, these states having more than 1/3 of their own tax revenues as pension outlay. So that will increase if these states choose either OPS or UPS and they do not stick to NPS. So the extent or the level of fiscal burden will increase depending upon the pension design they choose.
Right. And now, apart from all of the risks that Radhika already outlined, which is, the inflation indexation and the actual payout amount increasing in the future and things like that, politics also is a risk, because it's highly unlikely that this 18.5% contribution that the government is making towards UPS, that is going to come down. That's politically very risky. But politically, there's always a chance, just to win more votes, that they might increase it. They might say that we'll start giving 20%, say, in the future. Like it could happen. So all of these things can add to the future burden that this scheme is bringing about. Of course, it won't be as bad as OPS, but it's still a burden. Now, of course, we have some questions from the audience, and Aditya asks, do you think the government is again creating confusion by keeping both NPS and UPS? Shouldn't they scrap NPS and just keep UPS? And do you think, how do you think this is going to impact the fiscal consolidation target, as this might increase the pension bill for the government?
Yeah, so right now the government has given option to either retain, to stick with NPS, or to switch to UPS, and because the calculations will vary, some of the employees will prefer to remain with NPS depending upon their corpus, depending upon their investment priorities, and so on. So it is prudent for the government to not scrap NPS and give both the option, and depending upon how many employees migrate from NPS to UPS, the fiscal burden will also be determined. But as of now, the operational details are not totally clear. We do not know that the additional contribution would be invested in a separate corpus. What will be the investment portfolio? All of that we are not sure of. So we don't know what will be the fiscal burden, but definitely there is going to be fiscal burden, and we know that in the first year there is this additional burden of 6,000 odd crore already, and as you rightly pointed that it's highly unlikely that government contribution will reduce. It may well increase depending upon the inflation risk, depending upon the performance of markets. If markets are not performing well, then the upside will be limited, and the government would have to allocate more in the budget so that the allocation of the 50% assured pension payout is met. So, and depending upon how many people shift from the NPS to UPS, the fiscal burden will be determined accordingly.
Right, and no, apart from that also, right now NPS is open to the private sector as well, whereas UPS is limited to the public sector, to the government. So by scrapping NPS, then you will be removing the private sector from any of these pension schemes.
And also we have a well-developed architecture now in the form of PFRDA and pension funds who are managing this entire portfolio of employees, and this amounts to so many lakh crore. So it's not prudent to just scrap this entire pension architecture, which is now rendered uncertain with this new pension scheme. We do not know what will be the contours of the new architecture. Will the same architecture be retained and so on? So, but in all probabilities, the PFRD architecture will be retained, and that is prudent because that has been developed over the years, and we do not want to reverse all those hard-won gains that we have made over the couple of years.
And the other thing is that if the other option was to extend UPS to even the private sector, then that, at least in my view, is actually going to be more harmful than good. Because one, no private sector company is going to agree to assured pensions. Two, if it is at 18.5% contributions, basically what these private sector companies will start doing is they'll start hiring less. They might encourage more and more people to do these short-term contracts so that they don't qualify for UPS. And basically it'll have a negative impact on the private sector workforce. So even the government is unlikely to extend UPS to the private sector. They probably will keep NPS for the private sector and UPS for the government, or UPS and NPS for the government, whoever wants to choose, whichever government employee wants to choose, whichever one.
Yeah, and also the salary composition will change if the private sector also opts for the UPS, or if they are also forced to opt for the UPS, because then they might go in for lower salaries. They might not increase because then they would have to pay lower as a proportion of 50%. They will have to keep it lower. So all those considerations on employment, on hiring, on recruitment, on remuneration will have to be factored in.
Absolutely. And now Saurabh asks, given that UPS is contributory in nature, we're reducing future liabilities, but by increasing the Government of India's contribution compared to NPS, it will increase government borrowing, assuming that the capex plans and everything remain the same. So in a high inflation scenario, will the government be able to control inflation and keep growth up?
So yes, see, the entire composition of expenditures will definitely change if the pension liabilities continue to grow, and so that will now there will be two options. One, either that there will be some curtailment of productive expenditure, capex, or the other option would be that they keep the capex intact, but they increase fiscal deficit, and by extension the stock of borrowing will increase. And at a time when the government has talked about making the debt to GDP ratio as the nominal anchor for fiscal policy. It will be interesting to see what will be the debt to GDP target. So all these things would need to be worked out, and in fact in a high inflation scenario, I think the debt burden will be lower. So what is important is to see what will be the overall pension outlays and how it will impact the composition of expenditure. Will the government choose to curtail some of the other items of expenditure, or the government will go in for higher deficit and therefore higher borrowing? What will be the glide path of deficit and debt going forward? So definitely all these things need to be worked out, and for that, first what is important is to have the entire operational details of the UPS in place. Right now we only know that there are these key pillars of the UPS, but the entire fiscal cost and the entire operational details of the investments and all would need to be highlighted, would need to be studied, would need to be analyzed to come up with the exact assessment of fiscal burden of the unified pension system.
Right. And now there is a lot of controversy around this scheme because a lot of people, most of the people in this country are not working for the government.
Right.
And they're saying that our tax money now is increasingly going to pay the pensions of the people who are working for the government.
Right.
And this is not fair.
Right.
So, I mean, how justified are these? Is this criticism?
No, I think this is well-founded criticism, because right now a greater part of the taxpayer money will be used to fund pension liabilities, and till now that criticism was not there because it was purely contributory based. It was contribution from both the employees and the employer, but now the contribution will be shaped by the fact that how much contribution the government needs to make to ensure that 50% guaranteed pension is there. And as we pointed out earlier, that the entire workforce, the proportion of the central government employees or government employees in general is a very small proportion of the total workforce. So a greater proportion of fiscal burden is being borne for a very small proportion of the workforce. So it is creating this imbalance. It is creating this, and therefore it is the taxpayer money which is funding, and at the same time that money which could have been used for any productive purpose or capex or for employment generation is being used for for making payouts on pension. So that criticism is there, and that is well founded. So but the thing is that because there are so many states moving on to the old pension system, and this seems to be, as you earlier pointed out, driven by politics. It seems to be a counter to the opposition's move towards the old pension scheme, that hey, we are coming up with a system, we are coming up with an alternative which is fiscally more prudent as compared to the OPS. It is not creating that much level of liabilities on future governments, because OPS right now it doesn't create liabilities, but in future it creates liabilities.
Absolutely.
From 2030s onwards, when the retirements will happen, then there will be a immediate spike in pension liabilities, as the RBI study does a very detailed calculations of the pension burden that would rise if most of the states move to the old pension scheme. So it is the kind of a balanced compromise formula between OPS and NPS, but yes, there will be fiscal implications of this scheme as well.
Right. So there you go. That's actually it in a nutshell. The UPS, the new scheme, is better than the old pension scheme. It is debatable whether it's better than the new pension scheme or not, because I mean, if you're a government employee, then it probably is better because you're getting a guaranteed pension and most of the contribution towards it is coming from the government. It's not coming from you as the employee. Your contribution remains the same as it was under the NPS. But now what fiscal implications this has in the future, the fact that the pension payout is guaranteed to a certain level, that needs to be seen, because there are a lot of moving parts here. There is how the stock market will move, where the government is going to invest this pension fund. Is it in more safe areas which will naturally have lower growth? And so to make up any shortfalls, the government might need to increase its future payouts, its future contributions, that is. How it indexes inflation as well, how inflation moves between now and when the retirements start happening. That's going to play a factor in how much the government needs to contribute. All of this has a bearing on our tax money that could have been going to education and health and capex creation is now being allocated, a portion of it is being allocated towards the pensions of a small chunk of the formal workforce. Whether that's fair or not, I mean, it's debatable. It's largely the people outside of the government will say that it's not fair, and that's understandable. But overall, this is what we have for you. The details of the scheme are still not out, where the government's going to invest and all of that. But until they are, that's all we have for you. Thank you so much for watching.